Interest rates have technically broken out to the upside, and if you haven't noticed, it's putting a little bit of downward pressure over on the equities market. We've also got a massive bearish divergence to cover in the junk bonds today, so let's do what we do best, and that's building a game plan based on logic for the end of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe for 100K by May, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's kick things off with a closer look at the SPY daily time frame. What do we see here in terms of the overall trend? I would still make the argument that we're in an uptrend with lows, higher lows, and still the opportunity for higher lows around this zone at 517.25. Now, if we want to split hairs, yes, this is a lower low from Tuesday of last week to Tuesday of this week. However, the concession we made in the weekend update video was if we could stay above the top of this balance range, prior resistance back here, and use it as potentially newfound support, it would be very difficult to call it an outright downtrend. Now, of course, the threat is that we are potentially producing a lower high on the gap fill reversal from today's session, and that's something that we'll continue to monitor here, but I would not call this a daily downtrend yet. If anything, you could start to call this a neutral trend in the box here, where we're balancing once again, very similar to the neutral trend that we had just a couple of weeks ago. So for that reason, I would remain somewhat optimistic since the higher time frame weekly trends are up. It's very difficult to just throw in the towel and say, all right, here we go, markets are going to zero, right? As long as we're over this level at 517.25, I would still make the argument that the prevailing winds, the overall zeitgeist of the market, is for a move in the upward direction. So what do we see here in terms of candle structure that could be somewhat insightful? You'll notice that on Tuesday we printed a hammer candle right off of the 517.25 as well as the lower edge of the weekly expected move. The fact that we're finding buyers there does strike me as a positive outlook, but we have to counterbalance that with the very precise gap fill reversal at the highs of today's Wednesday session. What would the precision there suggest? That really short-term traders are the ones pushing around this market. We don't really have longer-term buyers stepping up, at least at the high of day from today's session. Longer-term buyers wouldn't really care so much about a gap fill reversal at 521. If there's a buying sort of order that comes across the desk at a large firm, right, they're going to buy until the order is filled. They don't necessarily care about this very nuanced gap fill reversal. So understanding that short-term traders are in control, that leads us to our secondary question: do we have stronger sellers entering the market? I still would answer that question with a no. There was a severe gap down on the Tuesday morning session, and we know that rates broke out in the upward direction. We'll get to the TNX in just a moment, but it didn't really violate structure. And because this is extremely indicative of the precision I'm referring to, because that's extremely indicative of short-term traders, I would still argue that there is no evidence of stronger sellers really getting active in the market. If we're going to start seeing stronger sellers on the daily time frame chart, we will completely concede when and if this turns into a double top via some sort of breakdown in price acceptance below 517.25. So on the daily time frame, although it's not so clear and we didn't get much follow through up and over the hammer high, we did close above, so that's a good step in the right direction if you're trying to be bullish off the top end of the previous range. It leaves a little bit to be desired here on the daily time frame chart. The upper wick, the reversal into the close, was not really helpful for the bull case here in the grand scheme of things, and I think it's starting to become a little bit more neutral on the daily time frame. So let's drop it on down to the hourly chart right now and start to examine that a little bit further. The hourly trend is certainly trying to flip in the upward direction off of lows, maybe higher lows into the close. Into the midday session, you can see at the bottom of this wick right here, midday, it was looking constructive for a higher low over the top of the Tuesday session high, which if we extend off to the left, was loosely in alignment with the low of the Tuesday session from last week. So if we could have held this higher low into the close and the consolidation was up here, that would have been really optimistic and bullish for buyers looking for continuation back up towards the top end of the range, right? In that case, you're just playing ping pong. Longs off the bottom, retarget the top. But as we can see, things got a little bit complicated into the close with this violation to the downside. Now again, there's still an offering of a higher low here, but it's not so clear in terms of what structure we're actually respecting. So as we walk forward into the end of this week, the game plan I would really set forth is just the idea that consolidation in here is exactly what it looks like. It's consolidation in the midpoint of a neutral balance range. Again, we're trying to concede the point by not being overly bullish that from here to here, technically there is a daily lower low. But I don't want to flip overly bearish if we're over 517.25. So consolidation in this zone right here is literally consolidation in the midpoint of the range. I would tend to fall back on weekly analysis and say, okay, we're in a weekly uptrend. We know momentum is in the upward direction. Is it possible that we could get involved on trades that look like this? So range sort of forms in here, not so clear. Break and higher low intraday over 521 targets the top of the range, and this flush point at 523. Very simply, in the opposite direction, breaks lower highs here, retarget 517.25. Now we have a little bit of an issue, right? If we're coming into an equal low reattempt after a lower high on the daily time frame chart, which we made the point of noting, right, off of 521, the upper wick of today's session, then this suddenly becomes a threat, equal low in short proximity of time. That becomes a breakdown point, and now we're underneath that key level at 517.25. So I really think that with some of the divergences playing out right now, and we'll see that when we get to the junk bonds in just a second, we'll see it when we get to interest rates breaking out to the upside, when we get to the IWM sort of not really playing nicely in its range, I think I would be very open-minded to this idea, and as of today's close, trying to remain a little bit more neutral as compared to overly bullish or overly bearish. Right now in the midpoint of this range, I do not necessarily feel as though any one particular side of the trade has an overwhelming edge. Let me also point out that the anchored VWAPs are pinching in between both of those key levels at 521 and 519, suggesting that this is neutral activity, and we'll learn something when and if we can get this higher low, or when and if we can get this as a lower high. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I think at first glance, the internals totally check out as being very, very neutral. If we look at the Monday volume flows, small outflows, Tuesday on the gap down, a little bit stronger outflows, but not near substantial, negative 300 million. And today, mild volume inflows. There's really not much to write home about here, with net volume flows on the week only negative 160 million. Substantial reads are negative 500 million or worse in the case of outflows. Right? The advanced decliner opens Monday positive, closes negative. We have to give credit where credit is due. Tuesday, we spend all day in trend lower zone, and today we open negative but close positive, almost the exact opposite of what happened on Monday. So again, a little bit more neutral there, a little bit of a bearish edge on Tuesday, but I've got a trick up my sleeve in just a second. If we look at the cumulative builds out of the tick down below, I mean, these look like substantial downside builds relative to what we saw to the upside today, but just as a reminder, substantial down here is negative 5,000. We hardly got halfway there on the Tuesday close, right? Negative 2,500 on like the worst reads into the afternoon. So what's this trick up my sleeve, and is it bullish or is it bearish? Well, if we take a look at the index score, which has actually performed really well here in forward testing, look at the index score on Tuesday morning session when we were opening in trend lower zone out of the advanced decline line as the market was going sideways. So I really think we should zoom in on the ES as we're doing this, right? It's creeping in the upward direction and even flips positive into the close. Remember that this measures 25 data points across the exchange. It's not just the sectors. It's not just the heavyweight companies. It's 25 data points all in one. And into the close of the Tuesday session, it flips positive with this breakout. So if we understand that the buyers actually had a little bit of something going on there, the open today back down inside of range and underneath this breakout point should have been fairly substantial, right? That would qualify this as a failed breakout with true buyers participating based on the index score flipping positive into the Tuesday close. So in theory, this is an edge for the sellers, making this a failed breakout. This morning, when we take it back out in the upward direction, supporting off of the top of the previous daily balance range, look at the index score here. It's definitely strong, up near positive 15. Again, that's a really solid read there. That, to me, is a little bit more of a bullish edge. So at face value, I think we get neutral internals. But if you add some additional information, like the index score, when you think about the psychology of the failed breakout on the open this morning Wednesday's session, think it starts to show a little bit more bullish compared to bearish, but we don't want to jump the gun. This is a data point that supports the bullish thesis, but it doesn't necessarily mean that we have decent risk-reward setups. We still need to look for the opportunities we just described on the hourly time frame chart, but I do think it helps us stay on course with the weekly time frame bullish nature, the daily trend remaining up. I don't think it's fair to say yet that we have overwhelming sellers entering this market. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's begin with our value areas and point of control on this week's session. Here is the Monday session, here is the Tuesday session, and here is today's Wednesday session. There's really two big takeaways here. Number one is that the value area from today's session is not only outside of the previous Tuesday value area, it's outside of the entire day's range. So remember where we open. The open of today's session is down here, basically at the low of day. If we extend that off to the left, that's opening in range in value of the Tuesday session. So if sellers are going to be successful in rejecting the very small M period spike into the close of Tuesday, this should have yielded sideways consolidation, if not a threat in the downward direction. With value breakaway to the upside completely outside of the Tuesday range, that strikes me as a strong indication that we do not have solid sellers here, and we're really more neutral as we described on the SPY daily time frame chart. Point number two is that we have a poor high. So structurally, if the high of today's Wednesday session is tested tomorrow, if we can open in value in range and test that high, we would be looking for some repair of that level, meaning a break through the level, and then the constructive trade would be a higher low above to rotate back up towards the top of the SPY daily balance zone. Changing gears to the QQQ NASDAQ 100 on the daily time frame chart, what do we see here in terms of trend? It's really a messy and ugly looking chart. I would not argue that we have a strong daily trend at all, and instead this is just a very neutral sideways consolidation zone. We are not holding the ideal place for a higher low. If you recall from the Saturday update video, we said that we maybe could have had lows and the opportunity for higher lows here if this upper balance range could have resolved in the upward direction for a higher high. Obviously, that's not the case, and we can see on Tuesday and today's Wednesday session, we are removed from the upper balance right here, and we're actually rejecting that on the gap fill reversal from today's high. So I'm very, very neutral, if not slightly bearish here on the NASDAQ for those reasons, right? Being in this balance range, in the midpoint of the balance range, and rejecting the upper balance, the micro balance, if you will, doesn't really strike me as being enthusiastic as interest rates are moving in the upward direction for a breakout in the NASDAQ 100. Now, I'll change my tone if we can get the clearance up and over 447.15, but on the daily time frame chart, we're sort of in no man's land and maybe with a bearish edge rejecting this as possible overhead supply that will continue to weigh on price action. If we take out these two equal lows, the bottom end of the range is a major threat because we know that that is the beginning of the NVIDIA earnings gap up below us, which technically closes underneath 433.75 all the way down to 425.75. So on the daily time frame chart, the upper wick rejection, the gap fill reversal, staying underneath this as a micro balance range does strike me as a small bear edge. There is no daily trend, but small bear edge here on the daily time frame. The weekly time frame chart is more neutral than the S&P is going sideways for multiple weeks now. Let's take a look at the hourly time frame chart, and here we can see a little bit of a different picture where there is a clear hourly downtrend with highs, lower highs, lower highs, lows, lower lows, and lower lows. This was just a counter trend move in the context of a pre-existing downtrend, right? And now that this gap fill reversal we just described is a rejection of this as an overhead range, to me, we're just looking for continuation back down to the equal low, if not follow through for a lower low. So how do we trade this walking forward out of the QQQ? The most bearish thing that could happen is just a full-blown retracement to the equal low. So price acceptance underneath 441.50 if we can if we can open underneath that for Thursday, looking for the equal lows at 438.50, and then a breakdown through that equal low for the next lower low in the trend cycle to take us towards the bottom end of the daily balance at 433.75. That's what the bears want to see, and that would just be very textbook continuation of this as an hourly downtrend. If the buyers are going to hold up in this zone right here, I would tend to be very neutral there. It's the midpoint of the daily balance range, and we're still underneath the overhead supply here here at 433.50. And therefore, I'm sure you know exactly what I'm going to say. If you're going to flip bullish out of the NASDAQ, you've really got to see clearance back in this range, but breaking that level is not enough. Show me the higher low in the range. Show me the price acceptance inside of this balance before we're going to start thinking about longs back up towards the top, which the target would be at that 447.15. If we bring out the anchored view apps for the NASDAQ side of things, you can see we're actually underneath a cluster of them instead of just wrapped up in the midpoint. I would say that this is maybe there's something going on from the Tuesday gap down anchored view app. Maybe there's a little bit of support here and a reason to be neutral, but for the most part, you're underneath this anchored view app, this anchored view app, this. So 3 of the 4 you're underneath. It doesn't strike me as being overly optimistic for the NASDAQ, and you don't really have key structure on the daily that you're trying to hold. This is no man's land. This is a really, really ugly and difficult chart to be trading right now. Again, just flipping it back to the daily time frame, if you're trying to make your job easy, you want a market that's trending, right? And this is certainly not trending in the midpoint of this range. We'll say at one time and one time only in today's episode, don't diddle in the middle. There's nothing to do here until you're clearly inside of the upper balance threatening a breakout, or if you start to get some breakdown under here because there is thin structure off to the left, targeting the bottom end of the range is not unreasonable as a short. We just have to get there first, which is 438.50, right? So you got to really clear that to the downside if you're looking for short setups. And again, back down to the hourly chart, how to achieve that is some sort of lower high here, equal low, and then a break. All the similar setups that we're always referring to are available at 438.50 if the bearish edge ultimately plays out. Let's take a look at the market internals for the NASDAQ side of the market, and you'll notice that we actually did have stronger volume outflows on the Tuesday session compared to the S&P. The S&P did not get substantial, the NASDAQ did. You can see the advanced decline line, we're well underneath trend lower zone, so it's not unreasonable that there was a counter trend move to unwind some of the overcorrelation. But Monday, not great. Tuesday sort of balances that out. I would say a little bit more bearish. Again, if we're looking at this just in terms of the magnitude of Tuesday, a little bit more bearish here for the NASDAQ. We do not have a full composite index score for the NASDAQ, so that's not a player here. But look at the cumulative tick, right? This speaks to the exchange level participation. What do we always say? A 45-degree line, that's steady selling all day long. And look at just the activity, zero activity over the zero line on Tuesday. Exchange level participation definitely outweighs in the bear direction. So neutral to obviously more leaning bearish here out of the NASDAQ, especially considering the daily trend, or the lack thereof, I should say, that we were just exploring on the previous charts. Let's move back on over to the market profile here for the NQ futures. And I'll make some of the similar comments that we did in the S&Ps, where you can see the value area on Monday, value area on Tuesday, and here is today's Wednesday session. So it does still strike me as a failure from the sellers to really get acceptance inside of that Tuesday value, even though they opened and clearly rejected a more meaningful spike out of the NASDAQ. So do we have stronger sellers, at least today, for the follow through on Wednesday? The answer is not really. Value is breakaway up and over Tuesday's range high. So those comments are similar to the S&P, but in the grand scheme of things, if you're going to choose the name with relative strength, I think it would be wise to choose the S&Ps. And if you're looking for a name to possibly break down and short more easily, I think the NQ is the place to be short, right? So ES longs, NQ shorts. Let's move on over to the Russell. So here we have it, the IWM Russell 2000, the small caps on the daily time frame chart. What do we see here in terms of the overall trend? I would argue it's trying to remain up. We have lows, higher lows, higher lows, higher lows. Here's where it gets a little bit sneaky. We had higher lows and now we have a lower low. But is this the end of the world? I would argue not yet, because we have highs, higher highs, and we're pulling back from the highest high in the trend count. Therefore, it's not fair to call this an outright downtrend. I would argue it's a little bit more neutral coming from that higher high. But what's the path forward here for a possible trend reversal? One of these things is just not like the other, right? This is the only index that did not close the gap overhead on today's session. So if we provide a gap fill reversal on Thursday, a little bit lower on Friday, it starts to set this up as a possible head and shoulders. We'll see it on the hourly time frame chart as well. And then a breakdown underneath this 204 really is asking for a firmer retest of 199 and 200. And what do we know is the issue with that? If we just really back this thing off to a monthly time frame chart, let's not forget about what we discussed on the weekend, right? First of all, we're kind of rejecting at a reasonable place. It's the bottom of this as overhead supply, right? That's point number one. If this is just going to be a massive like yearly lower high, my goodness, that seems like a big threat. But it's not really a realized threat until we fail back down underneath that 199 and 200, which is the top of this as a monthly balance range, right? So we're sort of caught between a rock and a hard place on the higher time frames. And if we just go back down to the smaller time frames like the daily and zoom back in, we can clearly start to see how threats emerge, right? Lower high, reversing the daily trend, equal lows, sort of retesting this 199, 200, that becomes a threat to the downside. I don't want to be overly pessimistic that this has to play out that way, but that's one of the concerns I have right now out of small caps, which as we know are extremely rate sensitive. And what did we say in the intro? What are we going to cover when we get to the TNX? The 10-year rate is breaking out in the upward direction over 4.3, right? So that's something that we have to at least be mindful of. If the trend is going to sustain itself in the upward direction, I would want to see not only a gap close, but a higher low over the highs of this little 2-bar range, today's high basically at 206.50. Another thing to point out on the hourly time frame chart is that the structures are not really being well respected out of the IWM. There's lots of volatility in the IWM. So look at the momentum that we had back here, right? A couple of things took place. This was inverted head and shoulders, great, broke the neckline in the upward direction. This was double bottom, great, broke the neckline in the upward direction. So where could higher lows have been found? Think about the multiple opportunities for higher lows out of small caps. Firstly, on the Monday drawdown, if we could have respected 208.75, great, there's a higher low in the context of a momentum breakout here and here. Simply did not take place. Big gap down. If we rallied out of the gates, I would call that close enough for a hold of this level around 206.50, especially if it was constructive. We battled back up into the Monday session. Obviously, it didn't take place, right? So we have not held two key structures. One is this, and two is the neckline of this. You'll also remember that this, as a head and shoulders, didn't really get big follow through. It turned into a double bottom, and now this is sort of like no man's zone down here. So I'm not really looking at the Russell in a lens of trust, right? I don't trust the technical levels that it's really presenting. I mean, sure, did we get a rejection at a key zone? Yes, but is the market structure acting the way it, quote, big air quotes here, I want to emphasize this, quote, should? Is it acting the way it should? Is it acting in a way in which we can trust those levels? Not really out of small caps, and the volatility here is somewhat concerning because one of the components of the bull thesis in the S&P 500 was that the broadening nature of the market rally was going to continue to propel the S&P 500 because it's far more diversified than just the NASDAQ 100, right? So if small caps really produced this as a newfound head and shoulders, lower high here, lower high on the gap fill reversal, equal low attempts towards this 204, I would be very cautious about remaining overly optimistic in the S&P 500, even if we're still stuck in that neutral balance range we just described on the daily. So those are my concerns out of the small caps. We'll, of course, talk about rates as the time comes. And let's move over to our intraday anchored VWAPs. You can see we're underneath 3 of the 4, just like the NASDAQ side of things. All of these are sort of barreling down or towards this 206.50. If we're rejecting this into the end of the week, I think it just sets up that very clear lower high. If we can get acceptance over it, I think you're looking for the gap to close. That might be a long scalp, and it might be intraday support for the S&P 500, but I would not overstay my welcome at the 208, right? If we just reverse there for the lower high, it's still bearish in the grand scheme of things, or even on the daily time frame chart, it just remains neutral with the opportunity for a lower high, right? And if we get a lower high after this lower low, that's where I would have to change my tone a little bit more so to a downside trend on the daily time frame chart. So we're not there yet, but I've sort of voiced my concerns about small caps, and hopefully you can kind of see where I'm coming from there. Let's move on over to the internals for the Russell side of things, and you can see substantial volume outflows on Tuesday's major gap down here. You can see the advanced decliner is in trend lower zone. Monday and Wednesday sort of neutralize one another, so we'll just count that as a moot point. Same thing here and here. Tuesday, though, substantial cumulative build out of the small caps. I mean, this is a solid read underneath negative 2,000 out of the cumulative. Right? Usually, what we're looking for is 2,000 or like 1,500 on the Russell side of the market. So I would take that as a serious data point, a little bit more sensitive to rates. Again, hopefully this is also making sense from a fundamental point of view. Let's take a look at the Russell profile, and you can see some of the similar commentary where the value area did drift higher in today's individual range. It is technically over the top of the Tuesday value area, but it's not completely breakaway outside of the Tuesday range as a whole. So I don't think you want to overcomplicate the Russell in terms of the tradable outcomes into the end of this week. Let's just jump back on over to the charts here, so it's a little bit more visual. I think you just want to keep it simple, right? Breaks into the gap are possibly tradable into the end of the week. Just be mindful of the lower high at 208. If we're just stuck inside of the 2-day balance, I really believe that that's offering a lower high, and threats become underneath 204 for downward pressure across the broad market. Let's take a closer look now at the weekly performance of our S&P sectors to really evaluate what's happening from a posture point of view. The XLE energy sector leads the pack here, up 2.55%, followed by the XLC communications 1.55%, and then it's the SMH, but notice the huge discrepancy in terms of net performance. The SMH is only up 18 basis points, not even 0.25%, so pretty substantial drop off there in the top three. One thing I will point out is that the energy sector is a lightweight sector. The XLC is a little bit heavier weight. Risk on the SMH is clearly a pretty risk on, not direct S&P sector, but component of the market. If we look at the bottom end of the barrel, it's the real estate sector, down 2.98%. As we know, it's rate sensitive, so seeing rates move higher, this is making sense. The XLV is also underperforming, down 2.45%. And as we know, the XLV is the second heaviest weighted sector by market cap, but it's also D for defensive, so it leaves a little bit to be desired as we're going neutral and sideways up here in the S&Ps. Underneath that, we can see the XLP, a lightweight D for defensive sector. That's not the end of the world to see that at the bottom end of the barrel. The XLK tech sector, the heaviest weight risk on sector, is still lagging though. It's down 0.63%. It is doing slightly better than the S&Ps on the week, down 84 basis points in the index itself. Let's check in on the structural charts and evaluate what's happening from a trend and structure point of view. You can see that we're breaking out to huge new highs out of energy, at least recent new highs. The all-time high, I believe, is coming into view as a test, $100.25, huge breakout of this as the monthly bull flag. We've been talking about that for quite some time now. Energy does look like it can continue in the upward direction. Let's go back down to a daily. Here we go, XLC. So again, the main takeaway as we rip through the sectors, does anything look overly bearish, like, oh my God, markets are going to zero? Keep that in the back of your mind. XLC, what do we see over here? Any issues out of the XLC? No. Breaking to new highs, consolidation resolving in the upward direction. This is bullish and risk on for the market. Next up, SMH, what's going on with semiconductors? So the hammer off of the gap fill reversal level again at 221.65, trying to resolve in the upward direction. I would look at this in particular because of the momentum and strength that's been there in the semis, and seeing the fact that the sellers can't really break down from this as an overhead range. You even got to look above and fail on the Monday session, right? The fact that there's no sell side momentum to not even make a new low, but just get down towards here, it doesn't strike me that, it's oh my goodness, markets are about to collapse, right? So if the semis are going to break down, you're really going to just watch for underneath 221.65 becomes a little bit more of a threat for a pullback to the neckline. When we get there, yes, maybe it's a lower high double top, but don't jump the gun, right? You can still technically find support off of the daily 50 SMA weekly equal low that could hold at 212. So as of right now, this does not strike me as Armageddon end of the world. And in fact, the hammer and then closing today back inside of the original balance range, you can see here today's close is inside of that, somewhat constructive. Just like this is a look above and fail, this could be a look below and fail. Target the top end of the range. If we can pop it, equal highs, all-time highs are back on the table. We're really not all that far removed from it. Really going to want to see how interest rates play into this sort of concept and idea. Let's move along to the real estate sector. Any issues? Is this making a new big swing low? The answer is no. When and if real estate breaks underneath 37.80, it will be more meaningful, but as of right now, not an issue. Here is the XLV. Who was it on Twitter? We were going back and forth about, hey, this is looking like, I was thinking bearish over here. You were right for the one-day breakout. I was right for like the longer run, flush of this point. So anyways, total hindsight trading now, and that's not the point of the video, but anyways, it's nice to go back and forth with other traders, mix and match opinions. If you're not following us over on X, you should do so. It's at Trade Brigade Co. and linked down below in the description. Anyways, here we go. XLV, inverted hammer, retesting the bottom end of the range. The gap is holding. To me, the watch would be for a flush underneath this. That starts to become an issue, noting that this is the second heaviest weighted sector by market cap. So what do we need to see, not want to see, but need to see in terms of rotation? You probably need the SMH to continue outperforming. You need to see some love back over in financials as well as the tech sector if the S&P is going to sustain the healthcare sector breaking underneath 144.80. I would be concerned about this acting as overhead supply. Downward pressure will be meaningful. Once again, noting the actual sector weight here in the XLV. Next up, we've got the XLP, consumer staples. This one, a little bit of change in tone here. One of the things that you can do, and again, we're not always, too fond of trend lines, but if you do something that looks like this, support, 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 right? We've broken that trend line. We're at the 50 SMA. Trend lines can tend to be a little bit more subjective, and I'm not in love with the idea, but generally as an illustration, the trend may be changing here. There's much stronger of an opportunity now for a lower high to be set. I'm not saying it has to be the back test of the trend line, but something that does this is much more of a realistic outcome. If we're underneath 75 for a lower high, this is overhead supply. It weighs on price in the downward direction. What's the difference between the XLP and the XLV? This is a lightweight D for defensive sector. So if anything's going to break down more aggressively, I would hope that it's the XLP and not the XLV for healthcare. Moving along to the XLY, what's going on with consumer discretionary, heavier weight, risk on style sector. Tesla deliveries totally derailed, just to stick on the D themes. Totally derailed. What's going on here? I mean, this was looking like a constructive break up and out of this as a prior range, look below and fail, and you can see we're right back down at the 50 SMA. So not all hope is lost. You're still technically holding on to this area of support at 179.25, but this is no longer as bullish as it once was. It has to dial back my expectations. I'm sort of taking a step back and saying, all right, kind of makes sense that we're flipping a bit more neutral out of the S&P 500 financials. What's going on over here? Looks great. Really no concerns with this. Sure, you could start to say look above and fail. It's pulling back. Give it a break. Look at the trend that this thing has been ripping through recently. There's really no issues out of financials. I would say bullish consolidation can take place up here. Give this thing some time to digest. If it wants to clear 42, that's great. Doesn't look all that encouraging into the end of the week with the inverted hammer, but not an Armageddon style chart. This is not nearly like, oh my God, run for the hills. S&Ps are going to come crashing down. Here's the XLU. What's going on with utilities? Nice little bull flag forming on the daily time frame chart. D for defensive sector, also a lightweight sector. Upward pressure is upward pressure. Give us the higher low over 64.25. That's great. If it breaks the bull flag without the full test first, it's going to dampen some of the downward pressure. Not all of it, not nearly all of it, considering how lightweight utilities are, but it's going to help the S&P from just an outright nosedive if everything else is moving lower, right? So this looks good and constructive in the grand scheme of things. We already covered the spiders. Here we go with the XLI. Industrials consolidating sideways. No issues out of this chart. Looking for follow through in the upward direction. Weekly or even daily bull flag there. XLK, very similar to the QQQ, as we all know, and really just in the midpoint of the range. So I promised I would only say it once. I'm not going to say it again, but you know where we are in terms of the range. Is it possible that you get a lower high and then some sort of threat through the NVDA earnings gap? That would be what the bears want to see. So here's the big if statement of today's video. If you are a bear, you are looking for the XLK to break down underneath 203.90, and that unlocks your bear thesis. I think the S&Ps will see a stronger pullback if that circumstance takes place. Finally, the XLB material sector, the lightest weight sector for the S&Ps, new all-time highs on the Monday gap up, rebounding right back in the upward direction. Upward pressure is upward pressure, but it is not going to make nor break the S&Ps. Here is the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The XLK leaves a little bit to be desired, but at least the trend is trying to neutralize with a little bit more sideways activity. Ideally, this gets back up to the 50 SMA and through the 50 SMA. I'm not sure how likely that is, considering what we just saw out of the structural chart. So keeping an open mind, but not holding my breath. The XLV, no issues. This is not like we have a risk-off rotation. Financials are still holding up okay, as we saw on the structural chart. No issues there. And the XLY, leaves a little bit to be desired, printing a new lower low. Very nuanced, but it is there on today's session. Ideally, let's get back up to that 50 SMA and through that 50 SMA to help out. Tesla deliveries really took the wind out of the sails from consumer discretionary. What do we see out of industrials? This is looking solid. Let's not forget that industrials are technically 8% of the S&P 500. It's a pretty decent look, strong risk on style sector there. Unfortunately, it's not like 20% like what we have out of some of the top four. In terms of the XLC, nice move in the upward direction. That is looking pretty solid, especially with the help from the metaverse recently. And you can see that risk off is not really a threat. Utilities are still muted. It's definitely over the 50 SMA, but not a concern. Energy is inflationary over here, and hard assets like real estate are not necessarily showing us risk off, but that'll change when we get over to gold. Huge breakout in gold, as we know. Here's the XLK over the SHY. So is there a flight to safety via government-backed versus the tech sector? No. I do believe that this can catch itself for a higher low and possibly another leg higher. Off of the 50 SMA, we're just not there yet, so this is still somewhat risk on. The XLK XLU is slightly risk off, and that's because it's underneath this as a flat horizontal level, printing new lower lows. If it rejects and continues to drift, that would be a concern for the marketplace. So this starts to neutralize some of the bullish tone that we just had in the XLK SHY. Here we go with the XLY XLP, apples to apples, consumer discretionary versus consumer staples. Neutral. This is like its new range. This was the old range. This is the new range. I have to give it some credit for making some upward progress, but it's not really doing anything meaningful here. It doesn't really show me, all right, risk on sentiment for the market. Not the case, more neutral than anything else. Let's take a look at the SMH XLV, so semis versus healthcare. This is looking risk on. This is looking risk on with this not turning into a neckline. Remember, the threat was that this could have been a double top underneath. Things get a little bit ugly. As of right now, this is looking okay, and that should really, that should ring true based on the SMH structural analysis that we just looked at, right? The sellers are not getting aggressive in the semis, whereas in the XLV healthcare sector, we saw a pretty gnarly gap down underneath that overhead supply. Let's move along to the dollar, and here's the dollar pulling back after trying to make a new higher high. I would think that with interest rates moving higher, if we can catch support in this zone, or I guess what I'm trying to say is it would make sense, it would be logical if we could catch support in this zone in the dollar over 103.75 for a higher low, continuing this little constructive trend in the upward direction. The only thing that flies in the face of this is gold. And obviously, dollar finding a higher low would be somewhat downward pressure for equities, right? As that sort of artificial, not even artificially, but it just tightens financial conditions through the mechanism of financing costs, right? So anyways, back to gold. Huge breakout. We've talked about this thing in the past. It doesn't even do it justice on a 5-year monthly time frame chart. We need like a 20-year chart. There's your massive cup and handle finally getting some follow through in the upward direction. Just for giggles on today's stream, let's come in with a Fibonacci measured move, top of the cup to the base of the cup. Let's see what we're looking at as a projection. We're talking about 2630.50 in gold as a cup and handle breakout. The S&Ps did it. They hit the cup and handle target. Let's see if gold is up next. And that, of course, in theory, should put some downward pressure on the dollar. So these two things are at odds right now. But I would tend to look at gold and what's happening over here as not an Armageddon sign, but it's certainly somewhat concerning that, sure, the structural pattern, it makes sense. But why gold? You have to go a little bit further than the technical pattern and say, why gold, right? Typically, gold is not really something that you want to favor over equities. If you're looking for performance, this is typically the safe haven asset. It raises some questions, and I don't think it's incredibly clear yet. It's sort of speculation, but this is small, minor concern in the back pocket. Let's move along, though, and take a look at the TNX. The whole topic of today's video, rates are higher and technically breaking out. Right? Look at the Monday session, huge move in the upward direction. But remember, on Monday, we didn't really feel the pain. Where did we feel the pain? When the breakout took place, when the move actually happened up and over 4.33 on the 10-year yield. Now, let's be very honest with ourselves, right? These are two back-to-back inverted hammers. Is that suggestive of continuation in the upward direction? Absolutely not. It would seem as though, rates might want to fail back down into the range, and the saving grace for the market to go higher into the end of this week or even early next week would just be if the labor market report comes in at or maybe slightly weaker than expectations, rates probably do something like this. But at that point, rates are moving lower for the wrong reason. The market might get a little bit of a tailwind. It's the wrong reason for the market to be moving higher based on a tight or even starting to crack labor market report. Now, based on all the evidence we've seen so far, I do not believe there's going to be this huge miss in the labor data come Friday morning at 8:30, but that's how this would play out in terms of the relationship, in my view. If we take a look at something like the /ZN, so this is the 10-year note, right? And we take a look at what's happening over here. This may be, just in terms of trading futures is a little bit more conceptually easy to wrap your head around. Look at the hammers here and look at where we're sort of finding that hammer possible support over previous resistance, right? So support, resistance, neckline of this as an inverted head and shoulders. When this moves in the upward direction, rates technically move in the downward direction. So if we're going to find buyers over this area of support in the notes, that would put downward pressure on the 10-year yield. So this to me is the main show. This is the main show into the end of this week. Do rates plummet through this level, or in terms of bonds, do they move lower, notes, Or do we get some support here, and do we rotate back up towards this level at the 111 handle? And if we can break out through that, that of course would put even further downward pressure on interest rates, probably alleviating pressures here as well. I don't necessarily, I'm not convinced that that's going to play out based on the fundamentals, but these are the reactions that we should be watching for based on the technicals. Let's move on over to the inverted ZT. We'll take a look at the 2-year moving in the upward direction. So because this is inverted, this is technically moving in the direction of interest rates, which is higher, right? So as this moves higher, we're continuing to probably come into a better balance, 50-50 odds on the tracker tool. Let's take a look. Oof, not quite at the 50-50 mark. Still 61.5% odds for the cut in the June timeframe meeting, and I would be expecting those odds to shift when the true NFP report comes out on Friday at 8:30. Speaking of the economic calendar, here it is. Let's do a quick synopsis of what has happened so far this week. The manufacturing numbers really came in strong here, all over the 50 mark, experiencing expansion, and that is being reflected as well over here in the GDP Now forecasts, which is suggesting back to above trend growth in the GDP. Now, again, the Fed does not have a mandate around GDP, but strong growth has to be something that Jerome Powell at least considers when they're talking about the monetary policy. If we go back on over to the calendar, you can see that JOLTS also came out this week, right on the money at the expectation, 8.76 million. We had a plethora of Fed speakers come out this week. ADP non-farms came out this morning, way stronger than the expectation, 184,000 versus the 148,000 expectation. Previous was also revised in the upward direction by about 15,000. And this brings me to a key point, which is that a lot of people talk about ADP not being accurate. There's always revisions. Well, revisions always happen. Revisions are something that's normal when it comes to refining the data set. So if we actually take a look at this tweet over here, Michael McDonough put this out a long while ago, but you can continue to get these updates over on the Bloomberg terminal. You can look at revisions historically. And if we just open up the actual image here, you can see that revisions, although yes, there are bearish revisions and there are moves in the downward direction, there are also positive revisions. So do with that information what you will. Revisions are normal, and we should be expecting revisions to the report in the next sequence when we get the updated numbers, right? So don't expect any major changes from that point of view, but something that's maybe a little bit more important to dive into from an analytics point of view is JOLTS job openings are moving in the downward direction, but the NFP is technically moving in the upward direction here. And we're going to get the true number on the Friday session at 8:30, but the estimates are for it to remain pretty high up here. So as the labor market is getting tighter, it's coming into better balance, and that is something that the Fed wanted to see. That way, right, there's better opportunities, or I should say lower opportunities for a wage price spiral to continue to put upward pressure on inflation. If there are fewer jobs, people aren't going to have that leverage to go out and ask for a higher wage, again, reducing sort of the wage price spiral effect for inflation. So to sum it all up, let's go back on over to the calendar. The important watches for the end of this week will be the unemployment claims, as always, on Thursday mornings at 8:30. That comes out tomorrow morning, and a number of Fed speakers. And then here are the fireworks for the week. The official month-over-month readings for hourly earnings, again, wage price spiral, the non-farm payroll change, as well as the unemployment rate. This will be something to keep an eye on right here. I'm not seeing any issues with the data reported. The forecast for the NFP is a little bit light here at 212,000, but we'll see how the number comes in. With that said, let's take a look at risk appetite. So first up is the TLT ratio to the S&P, and it continues to drift in the downward direction, not really suggesting any flight to safety style trade, and therefore risk appetite for equities down below remains somewhat stable. But this can be somewhat deceiving because if we look at bonds in relationship to themselves, the shorter end of the curve is actually looking a little bit more attractive. Now, we haven't made higher highs yet, but if we get these breaks into the end of the week, it would suggest that there's preference for the shorter end of the curve, aka less risk appetite. That would be a bearish headwind for equities down below. Let's move along to credit spreads, and these guys are still just sitting on the lows, tangled up near 50 SMAs. No major threats out of a credit event right now, but HYG in isolation is a huge red flag. It was so big that we had to mention it in the intro, right? If we flush underneath this 76.60, that has to strike me as a major risk off style indication for the broad market. We can stay okay if we're just kind of sideways here. We know that there's been a major divergence with all of these sort of equal lows as the market has continued to truck along in the upward direction. But if this breaks down underneath 76.60, I think it becomes too large of a divergence that the market can no longer afford to ignore, and that would be a bearish bearish headwind for equities down below in the S&P. So just to give you an idea into the end of the week, breaking 76.60, and we probably do not hold on to 517.25 in the SPY cash ETF, right? Let's move along to Bitcoin and see what's going on in the digital gold, and it's putting in bull flag consolidation up here, looking for possible continuation over 74.1, and that would sort of trigger the second wave of sort of crypto mania 2.0. So watching out for that, but the pattern is constructive, and generally speaking, when crypto is performing well, it has to be some sort of indication that risk appetite is still stable. So the HYG is the one major outlier and the one possible threat. Bitcoin would align more so with the bull thesis so far. Let's move along to new highs versus lows, moving into breadth, right? A little bit of a contraction this week, but still over the zero line. Just as a reminder, you do not need these huge reads to continue to get drift in the upward direction or even just bullish consolidation. So not throwing in the towel just because there's a sharp downtick. Let's move along to the SPX A200R stocks trading over the 200 SMA. Minor downtick, still well above these previous areas of resistance. So all good there. And we'll move along to the SPX A50R, a little bit of a pullback. So we've sort of understood that breadth is maybe cooling off just a little bit. So it shouldn't come as much of a surprise that the RSP is also pulling back into a very reasonable level, right? If we can hold support here at 166.25 and continue to build out consolidation, great. You're probably not going to get this huge downdraft in the S&P 500. If this produces a head and shoulders, we get a lower high and then we flush this neckline, that would start to strike me as being much more concerning, especially noting that things like the SMH, things like the XLK as a sector, they're not really trending anymore. They're really just going sideways. So if equal weight, if the broadening nature of the market rally is going to slow down or even contract a little bit by breaking below 166.25, it's a small concern into the end of this week. Again, I think that this aligns with the analysis we've put forth so far around the IWM as well. Let's move on over to the QQQE equal weight NASDAQ. This is much closer to threatening this breakdown compared to the weighted NASDAQ. If this goes first, it would tend to strike me as a bearish indication for the weighted NASDAQ, probably looking for that NVIDIA earnings gap to be in play below us. What about Dow Jones Transports? Because we were watching very closely for the possible break up and over 16,150. It did not take place. We're back down in the midpoint of the range. As I said earlier, I was only going to say it once. We're going to stick to that. We are in the midpoint of that range. You guys know exactly what not to do in the middle of a range. With that, we'll move along to volatility. What's going on with the VIX? A little bit of an uptick here towards that 15 ceiling. If we reject and back off into the end of this week, probably just a bullish indication that we rotate back towards the top of the range. So you could look for this as a piece of confluence with your analysis. If you are a bull, you want to see this continued rejection back down towards, loosely 1250s, 1260s. If we take a look at the VVIX, the volatility of the volatility index, we got the sort of textbook reaction, right off of 75. This is where the market gets a little bit overly complacent. The large gap down gapped this up here out of the VVIX, but we're not up and over 103. So sustained volatility, sustained, oh my goodness, markets are getting out of hand, like what we had back here, what we had over here with that higher consolidation, right? Notice how this consolidation is sort of over these highs from in here. It's not really in play. So I wouldn't look at this as an overwhelming indication that volatility is going to creep up from behind us and just rug pull the market and cause a huge drawdown. We're not at that stage yet. Let's move along to volatility futures, and we'll take a look at the core list of companies. Small drift towards some sort of backwardation, but we're still very deep in a contango in the first place. So, is it a step in the wrong direction? I mean, technically, but look at how far you're still underneath the zero line. I would not really see that as a major threat in terms of volatility. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Do me a favor and hit the thumbs up button and subscribe for 100K by May. And let's kick off the core list of companies with none other than Apple. The pattern in force on the daily time frame chart is a major H pattern. If we can flush these lows, looking for 167, then the next daily support below that is 162.75. Let's drop it on down to the hourly time frame chart to get even more granular. One of the things that I would want to point out here is the lack of acceptance into the close over this level at 169.80, 82. What are we doing over here with a couple of pennies? You guys know the rules. Round numbers only up in the penthouse suites. There we go. That's looking better. Look at the inverted hammer into the close. So jokes aside, this rejection of that level. So we poked in. This was looking okay on that hammer. The failure into the close strikes me as substantial, and I would be looking for lower based on that, right? We have a clear hourly downtrend with consecutive lower highs, looking for the equal low, if not flush, into lower lows at that 167. So Apple trying to align with bears. If we are going to be bullish on Apple, I wouldn't even really trade for this sort of rotation in here. I would really need to see price acceptance over 172. If you can get back over 172 after making a lower low, I'd give the buyers back control here and maybe start looking for a stronger counter trend on something like the daily or weekly. We're just not there yet, and into the end of day, I would take that as a substantial takeaway. Let's move along to Microsoft. What's going on out of Softy? Again, a lot of these tech companies put in inverted hammer. So if I just flip back to the daily, right, inverted hammer here, these large reversals into the close after a morning rally, inverted hammer. So as we're thinking about that, we know that the bears sort of build an edge here, and a flush through these equal lows I think become very straightforward. We have daily highs, lower highs, hourly lower highs, equal low flush, doors open into 415.75. I would try to align with that, and the tradable outcome there is a 5-minute lower high underneath, 15-minute lower high underneath, targets that level down below. If we're just chopping around in here, I would really try to exercise some patience. I would not be willing to flip long out of Microsoft until we're up and over 423. 423 as today's high of day, getting a higher low over that for something that, so this is consolidation. This trades back up to the top of the range, 426.75. Next up, we've got GOOGL. The stock certainly broke out of its consolidation inside of this rising sort of wedge. It's not really a rising wedge, it's an ascending triangle to use the proper terminology, but you get the idea. Strong breakout here, offering multiple higher lows and trading right back into the equal highs. So blue sky territories await us overhead, over 155.50. I mean, again, blue sky territories trading whole and half dollars, any intraday levels that form. I have to stay bullish on this as long as we're over 151.15. If there is a stronger pullback, even if we were to retest this, I would still put my bull cap on and say, where can we find the double bottom, the inverted head and shoulders, the very simple hammer candle? Where do the buyers step up? Do the buyers step up on the retest of the breakout point, 151.15? Only willing to flip bearish if we drift underneath with a lower high. If this happens here and all of this turns into a fake break over the span of 3 days, that would be a massive red flag. So please understand, if we get acceptance underneath 151.15, I am very willing to look short out of Google because this is a huge failure to break to new all-time highs. All right, so that is Google up and down. Next up, we've got Amazon. What's going on with Nancy here? Great breakout trade today over that 181. We talked about it in the pre-market prep. Beautiful consolidations. Let's just quickly go down to a 15-minute chart. We don't do this often, but look at previous support acting as resistance, support into the close of the Tuesday session. Here's Tuesday's close, right? Look at this breakout. Huge breakout, nice consolidation. So as of right now, trying to align more so with the bullish continuation, going back to an hourly chart here. The idea is any higher low retests over 181 or breakouts over 182.80. Next level overhead offers a little bit of room to run into 185.25. If we're going to flip bearish, you really want to see a move underneath 180 flat to get back down inside of this as a balance range. Next up, we've got NVIDIA, the one stock to rule them all, which isn't really ruling them all at all. We can see that we're really just sideways inside of this range. Beautiful lower high on the Monday session over here. And as we walk forward, we're sort of towards the midpoint of the range, and we're not really offering clarity around this prior set of lows. Ideally, you would have gotten lower high here. You would have gotten a break and a hold above if we were going to rotate back up to the top. Obviously not the case currently. So a little bit more neutral around 894, sort of 50. I just want more information. I want more structure out of NVIDIA, perhaps taking a little bit of a long opportunity if we can get some sort of break up and over 905, back up towards 922. Maybe a scalp from point A to point B up here. But one step at a time out of NVIDIA. Next up, AMD deserves a little bit of recognition just because it's pushing back up towards the top of the range after sort of testing the midpoint, if you will, but still taking it one step at a time. Like if we can get something that looks like this, fine, we'll trade it. But for now, it's just building out a balance range. So do not overcomplicate AMD. You've got to be up and over 183.60. Next up, the metaverse. What's going on with Zuckerberg's Fantasyland? This is a huge outperformer for the XLC as a sector, right? And you can see that we are getting bullish consolidation over the top of the previous balance range from back here. A little bit of inverted head and shoulders look from in the past. Nice solid move to the upside today. Difficult to trade off of the open, and the idea would have actually been for a lower high underneath. But now that we're getting this acceptance above 501.50, it's a different setup. Just quite simply put, it's a different setup. If we can find the higher low over, then great. We'll flip back in the upward direction and really just try to align with a neutral overall trend. And if we can get great location off of structure, maybe it's worth taking a stab. So in the grand scheme of things, yes, you are towards the midpoint of the range if you're interacting here. But if the location is decent, if there's a decent intraday setup, so there's a pullback or something of the sorts, and you can go entry, stop, and target back up here, target this high of day. If you're going to pull off like a 2 or 3 to 1 risk reward ratio, there's nothing wrong wrong with that as long as you know exactly where your stop is and you sort of acknowledge that we're in the midpoint of this overall range. It would be better if we had a stronger daily trend behind us, but we simply don't at this point in time. If the bears are going to make something happen, show me the lower high underneath, and then we'll drift back down towards this neckline closer to 495. Next up, we've got Tesla. What's going on with Tessie and Mr. Musk? Deliveries absolutely hammered the XLY as we saw. It totally invalidated the opportunity for a right shoulder here if this was going to build out as inverted head and shoulders. So the next real watch is just a lower high on the gap close or a lower high up against 173.25. Looking for both of those outcomes into the end of this week, or I should say one or the other of those outcomes. Equal lows are the target at 163.75, then follow through into 159. Last but not least in the core list is Netflix, and then I've got 3 additional ideas to share with you. This is just as simply put as we can make it, the absolute heartbreaker trade. I mean, to fail the breakout up here after multiple days of consolidation looked like a huge aggressive failure, possible lower highs underneath, not even the breakout point, but underneath the breakout point at 616. This, to me, I don't want a revenge trade. It will take it at face value. If we can continue to get acceptance, if there's a decent risk-reward opportunity around 623 for continuation, maybe. But at this point, like, you just have to keep contending with all of these overhead resistance levels, right? So 633.50s need to break before you're possibly opening the door into 644.75. So I'm sort of pleased that we've added AMD into the lineup based on Netflix and the heartbreaking activity of the stock recently. But, we'll just take it at face value into the end of this week. Got to call it for what it is. Bullish over here. Maybe if someone was catching that as a double bottom, great, kudos to you. But based on the failed breakout here and the move back lower, I was actually looking for lower highs. Simply did not play out, right? So anyhow, that is the core list. Let's move into these 3 trade ideas. First up is on UNH, United Healthcare. As we know, the UNH sector, the XLV sector, there we go, is bearish, right? It gapped down big time. And obviously you can see the major gap down in UNH. But look at the inside bar. Look at the longer, lower wicks. I think if there's going to be some sort of oversold counter trend move for some kind of gap close overhead, now please don't get me wrong, we're not looking for the gap to close in one day. But if we can drift into the thin structure, that would be somewhat attractive. Dropping it on down to the hourly chart again, you can start to see that this is hourly cup and handle. If we can clear 463.15s loosely into this gap, looking for upside trades. We don't have a very well-defined target, and again, maybe the gap close is in play over time, but looking for longs if we get an oversold reaction out of UNH. So that's trade idea number 1. Next up, we have TSM. First of all, anybody from Taiwan, relatives in Taiwan, wishing them nothing but the best based on the sort of the earthquake that's going on there. Never sort of easy to be dealing with natural disaster, but TSM as a trade setup, right? Ascending triangle here, flat top. If the semis are going to bounce back in a strong way, remember what we were discussing over on the SMH. If this breakout takes place, 146 is a day trade scalp, so something that can do this is a day trade. And then look at left at this thin structure, right? Retracing back to the opening print of that bar, that leaves a lot of range overhead to be trading for. Not quite 10 points, but 154 after the clearance of 146. So that is the upside trade out of TSM. It's in play as long as this consolidation is taking place. I would probably become less interested if we're back down underneath 137s. If we crack underneath 137 loosely right around in here, I think you're just trading for an equal low, and this sets up a big weekly lower high. That would be no good. But as long as these can kind of hold, and you're trying to make progress in the upward direction, trying to align with this. And then the last trade idea I have for you is Disney. DIS is the ticker there, obviously. And this is really more clear on the hourly chart, so we're going to start on the hourly, but we'll look at the daily as well. As a double top, I mean, the reversal's already underway, right? We've broken down through that neckline, so our job is fairly straightforward. Lower highs happening here, or straight up continuation into this previous breakout point. I think that's the name of the game. So your levels are going to be 120.20 and 117 as a possible downside target. Here is the daily time frame chart, and the reason I want to show you this is because the daily bar is actually a bearish engulfer. Didn't open over the previous day's high, but it did test over the previous high with the upper wick of the bar. So buyers completely failed to produce a breakout in the upward direction. Sellers really took hold, broke down underneath that neckline we just saw, and closed it fairly weak on the day's session, looking for a retest of this level. If it goes further, the next one below is around 113.50s. That's all I've got for you in today's episode of the Midweek Market Update. If you learned anything new or enjoyed the video, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember, we will be live for our pre-market preps, as always, at 8:15 here on the YouTube channel, completely free and open to the public. We will have coffee and donuts on the Friday session for our labor market report. With that said, everybody, have a green trading week, and I will see you in the next one.